Hello, and thank you for joining us at xm.com for today's daily market comment by Mario Sachikiriakos. I'm Christina Marujos. Global markets have turned into one giant trade in recent months. Almost every asset class is driven by the same two elements: the intensity of inflationary forces and the threat of recession. The bond market has been at the epicenter of this shift, with spikes in Treasury yields serving as the transmission mechanism that drives the price action in the Forex and equity markets. Euro-dollar encapsulates this pattern perfectly, having a strong positive correlation with U.S. stock markets and a strong negative correlation with U.S. yields. It's a similar story for dollar-yen, sterling-dollar, and many of the commodity-linked currencies. Of course, currencies have always been very sensitive to interest rate changes and risk appetite, although this relationship has strengthened further recently. Hence, it's still difficult to call for a reversal in euro-dollar. The outlook for growth in Europe is worse than America, and underlying inflationary pressures are softer, so expecting the European Central Bank to keep pace with the Fed in raising rates, as market pricing currently implies, over the next year seems like a stretch. And with liquidity fading globally, equity markets are likely to remain volatile, which generally favors the dollar. Oil prices got knocked down yesterday by reports that OPEC is considering suspending its alliance with Russia, allowing it to ramp up production. It appears the secret talks between Biden and Saudi Arabia to raise production were successful, begging the question of what the White House had to promise the kingdom in return. Another question is whether Saudi Arabia can even raise production, with many arguing there's almost no spare capacity left. Tomorrow's OPEC meeting just became a lot more interesting. Staying in the commodity sphere, gold prices suffered a sharp drop yesterday to cross back below their 200-day moving average, dragged down by the revival in the dollar and real U.S. yields. Crossing into Canada, the central bank will meet today, and markets have fully priced in a 50 basis points rate increase. As such, the reaction in the Canadian dollar will boil down to the tone of the statement and any signals about how hard the Bank of Canada will strike in the coming months. The Canadian economy is booming, with the only area of concern being the nation's bubbly housing market, which has started to show cracks now that mortgage rates have risen. That said, it might be a little too early for the Bank of Canada to highlight this risk. This was a Daily Market Comment. Thank you for watching at xm.com.